Hello, this is Amaka Ifebunando, the Excel coach. In this tutorial, I'll be walking you through on how to impute transaction into a pre-designed template, which is the automated financial statement. Now, we're going to be using a case study for a startup company, a company that is just starting up, and we have a few transactions that spans for 2 years, which we're going to be using to illustrate how this template works. Now, the template is designed to generate the income statement, the statement of financial position, also known as the balance sheet, and the cash flow statement. So as you are making the input of your daily transaction into your journal, this statement or this report automatically generates itself alongside trial balance, right? So I'll walk you through this template in this tutorial. It's a premium template. It's already been pre-designed. It's a premium template. So if you would like to have it, I will drop the link on how to access the template. It's not free, it's premium, right? So I'll be showing you the case study we're going to be using side by side along the Excel workbook, and we'll be working right through each of the transaction on how to capture it in this template. So we are looking at a whole lot of the life cycle of accounting, from where you enter your make your journal entry, your general ledger, your trial balance, then you generate your income statement, balance sheet, and cash flow statement. And this is all automated. So let's go right into it. So let me just have my uh, PDF case study side by side alongside the Excel workbook. Right, I believe we can see it. So this is this case study we'll be working with, automated financial statement in Excel, a practical guide using case scenario. So this is the first case scenario. Subsequently, we'll have other scenarios where we'll be testing different kind of business and different kind of transactions. Right. So this is the case scenario. So the case study is Amaka Global Perfume. So it's a startup company that deals on purchase and sales of perfumes. So the business type is a retail perfume that deals on perfume. Then the currency we are using is the Nigerian naira, but it doesn't restrict you for you in different country. You can use your dollar, you can use your pound, you can use your for any country you are. You can just use the currency that suits you. So for the purpose of illustration, using the Nigerian naira. Right, so the time frame of transaction we are looking at is from January 2024 through to May 2025. So we'll be looking at like 2 years transaction, just a few transactions to illustrate how to capture transaction, especially your accounting entries, basically how to capture it, and on these templates, and you see the impact of what it will have for each of the transaction. So for the template, let me just maximize the template. Let's go through it before we go back. So you can see we have this just for information purpose. That's why I call it the info sheet. So for information purpose. So we have the setting. On this setting sheet, you'll just have to input on the cell with the yellow or like orange cell fill. This and this, these are the cells you're going to make input. So the cell with the orange fill are the cell you're going to make input. So first of all, when do you want to start using this template? That's the first thing. So you input your start date. So for us, based on the case study we are working with, we presume that 1st of January 2024 is the day we started using this template, right? And mind you, this date here is the date you want to generate the report. It's as the report end date. So date must be greater than or equal to the template start date, which is just the normal thing to do. Your date, your report date should be greater than or equal to the template start date. So we want to generate report as at 31st 12 2025. So let's just leave it at 2024. If I put in 2024 here, you'll notice that the report start date automatically compute itself. And for the previous year, because this template will be giving you previous year report and the current year report. So you haven't input the date you want to generate the report. So it will generate that current date based on the 12-month calendar period for that current year you have imputed, and also generate the previous year. So the only thing you need to impute here is the date, the final date of the report. Let's say you want to generate report for the year ended 31st December 2024. So definitely your financial statement will be as at 31st December 2024, and your cash flow will be for the year ended 31st December 2024. So alongside, you also get the previous year so that you can compare side by side. So you now impute your business name. So the name is Amaka Global Perfumes. Amaka Global Perfume. Right, that's the name of the business. So immediately all the sheets will have this name updated on it. Right. So this is what you have to do in the setting. Here has formula. The cell with the white, this one without any field has formula in it. And this is for accuracy check. So whenever your financial statement is not accurate, that is your balance sheet does not balance, you see it will state you not balance here with a red field. Right, so the only input you need to make just for emphasis purpose is in the cell with the yellow fill. Please note that. Right, so that is it for the settings section. Let's go to the chart of account section. Now for the chart of account, this is already, we already have the codes here imputed. So if you want to learn more about chart of account, you can watch my previous videos where I talked about chart of account, trial balance, general ledger, and even the income statement and balance sheet. Right, so you can just go there to watch for yourself. But this is just a guide for you. This is the code range. Your code can be numbers. Your code can be alphanumeric. That's a mixture of number and alphabet. Right, so you have to know which number falls into assets. You have to classify and categorize it that way. Now, looking at our example, we've already categorized that all the one fall into assets, whether current assets, contra assets, non-current assets. All the ones fall into assets. Then when you come to two, all the liability, is it current? Is it non-current? Long-term, short-term liability, contra liability, all falls in the two range. When it comes to equity, it falls in the three. Everything under equity, equity drawing, retain, and they fall into the three range. Then you have your four. 4,000 is for income, all the incomes, all things related to income. Then you have your 5,000 through to 7,000 is, okay, 5,000 is cost of goods sold, right? Cost of goods sold. Then 6,000 through to 7,000 is expenses. So this should serve as a guide for you when designing your chart of account. And your chart of account depends on the kind of business, you are into, or as a professional, the kind of industry you are into, based on the transaction and what makes up their system, that's the accounting system. That's how you will design the chart of account. Now, having given the range, you come here and design based on the nature of transaction that is in that business. So looking at our case study, we've already seen the nature of transaction that are in this business. And based on the nature of transaction, from there we designed the chart of account. So when we are looking at the case study, we'll look at it and I'll explain to you further how I had to pick up each of these different accounts and code them right. So here, have it in mind for this sheet, the heading with the yellow field has formula. So it's like contradicting here. It doesn't have formula for the yellow field, but here, the ones with the yellow column heading has formula. So you don't need to impute anything here. You see, it has formula. All you need to do is just to put in the code, put in the account name, and select the account type. This automatically fits itself. So you just need to put in the account code, account name, account type, and this automatically fills itself. So this is the default balance. As you know, in accounting, for you that are not accounting, I won't bug you much, but this is just applying the double entry principle, and this forms the basis of accounting at whatever level you are, in whatever country. This is the basis, understanding the double entry principle. And for every account type, there is a default balance. And this default balance has been created here. Immediately you put in the account type, the default balance pops up immediately. So the template also generates your trial balance, current year and previous year. So these already have formula. So for all the cells I say they have formula, be careful not to tamper with it when you get this template. Don't tamper with it so that you won't alter the performance and the accuracy of this template. So that is all you need to know in the chart of account section. Have it in mind that as transaction keeps increasing, there are possibility for you to create additional accounts. And when you create them here, you also, there is something that you need to do. You need to go back to your financial statement to update your account, ensure that that account type is captured. These are the things I want us to know about this template, especially for the chart of account section. Now let's move to the general ledger. Here is where you're going to be doing most of your work in. You're going to be capturing all the daily transaction, applying the double entry principle. As you can see, we have an accuracy check here. Mind you, the name Amaka Global Perfume automatically pops up because there is a formula in here. All you need to do is to input your business name here, and it's automatically filling all the sheets. So you can see that Amaka Global Perfume general ledger entry is already automatically here. So for accuracy check, this will tell you at every entry you're making if your journal is balanced, your general ledger is balanced, right? So this has formula. So for this particular section, what you need to do is to impute in the cell with the green fill heading. For the one with the orange or yellow fill heading, it has formulas. You can see we have formula in here, we have formula in here, and we have formula in here. So you need not to tamper with this columns, column F, column I, column J. They have formula in them. Even in this cell where you have the balance area formula. So please note that. So when you're making your entry, especially here where you'll be doing most of the work, be very careful so that you don't tamper with these columns with formulas, right? So that is it for the general ledger entry sheet. So we'll go to the financial statement. Everything here is automated. You're not making any entry here. The only time you need to do anything is when you introduce a new account into your chart of account. You need to come to your financial statement and update each of the reports that this account is imparting on. And that is why you see that at the end of each of the section of a report, we'll put a line, a thin line, where you can insert another line and capture that account you just created. That is it. So for here, you don't need to tamper with anything. It's only when you introduce a new account type and in that account type is not appearing in your financials. This is just the only action you need to take. If the accounts that are here are okay for you, you're good to go. But if you need to, update a new account you just added into your chart of accounts, then you do it. But I'll be showing you that. So this is just the only thing you need to do here, right? So let's just go right in. Let me not say much. So you can see we have the income statement here. You can see the name Amaka Global Perfume, the statement of financial position, which is also known as the balance sheet, and down you can see the cash flow statement. So when you click on your print preview, let me just show you so that you see it's just 3 pages. So this is the income statement. You go to the next page, there's the statement of financial position, and this is the balance sheet. So all has been formatted appropriately for you to use. All right, so this is all you need to know about the template and each of the section about the template. So let's go to the case study we are working on and let's get down to work. Right, good. So we have the case study here and we have the transactions. So first transaction says that on the 2nd of January 2024, Amaka Global started a perfume business with 3 million in the bank. Right. So 3 million, just give you some notice and owner's capital. So we go to our general journal. So you just follow me closely. On the 2nd of January, we may not go through all, but I will just show you how this works. 2024, at whichever point we stop, I know you can pick it up from there. So we just call this startup capital, right? This is startup capital. Startup capital. So what account is going to be imparted? Now, this is where I want you all to pay attention because the entry you make here is what will impact on your final report. If your daily entry into your general ledger is wrong, your report will be wrong. The balance might be okay, the trial balance might be okay, but it's going to impact on your report and will also impact on the decision you're making and preferring to the management, right? Now, startup capital. The startup capital is what you're going to select here. And I believe we have a startup capital, owner's capital. So You can see it in the chart of accounts. We have the startup capital here, which is our owner's capital. So this has already, you just select from the drop down list. Immediately you select the startup capital. Mind you, it tells you that it's an equity account type. Are you seeing it? It's an equity account type. So mind you, for startup capital, it is a credit balance. You see, the default is a credit balance. So, and we are starting with 3 million. So 3 million goes to the credit side. All right. So I'm done with the first leg of this transaction. Our accounting principle says for every credit, there is a debit. So this is just an accounting, term, jargon, or so to say, yeah. For every debit, there is a credit. Now, because we have not done the debit entry, it's not balanced. So we have to do the second entry. Then you are done with this number one transaction. So I'll just copy and fill down, you know, just Control D and copy. Now, for this is the same date, the same description. Now, for the account name, because money is coming into the organization, it's owners, Amaka is bringing her money. This is the money I'm using to start. So it's an owner's capital, but the first is owner's capital, then the second is money into the bank. So your bank, right? So Ultimate Bank is the bank we are using. So Ultimate Bank is a current asset, right? And the default balance for Ultimate is debit, right? So we're going to now put 3 million the debit side. So watch and see that here immediately it says balance. Are you seeing that? So that is how the entry is going to be going, right? So let's move to the second one. It says on the 4th of January, maybe after I've done like, okay, I'll have to do each of them so that we can see how, because some of the transactions are unique in themselves so that you will see. I may not go through all, yeah, just for you to understand how this works. Do you get that? So on the 4th of January, Amaka Global Perfume purchased 200 units perfume on credit from ABC Limited. So there's a purchase. So we'll say on the 4th of January 2024, there is a purchase. So we'll say purchases, right? Perfume purchases. Perfume purchases from ABC Limited. Okay, so there's a perfume purchase, and if there's a perfume purchase on credit, meaning that we didn't pay, we took it on credit, right? So our account payable will be affected because we are owing the vendor, right? We are owing the vendor. Then another account will also be affected, which is our inventory, right? So we are making purchases on credit. We are making purchases on credit. We are not paying. So because we are not paying, account payable is affected and the goods is going to our inventory. Are we good? So first, we'll start with the inventory. We're making, mostly we start with the debit side, right? So then what amounts? You see, it says 1,200,000 because 6,000 per unit. We need this per unit cost of purchase. So 6,000 per unit, 1,200,000. All right. So the next leg of the transaction, the next, because it's double entry, right? So, so they say account payable. So you can just type account payable and select this. So it's a current liability. We are owing ABC. We didn't pay. We bought on credit, right? So you take it to the credit side, 1,200,000. Right. So we'll move to the next transaction. And the next transaction is on the 7th of January. It says we drew 100,000 cash to cash till. So maybe for your impress to use it and spend on little things, might be electricity, fuel, those little money that you don't need to necessarily go through the bank and make transfer, right? So on that 7th, we move money, we withdrew Amaka Global Perfume. We withdrew 100,000 into the cash till, right? So see on the 7th of January 2024, uh, cash, let's say cash from bank to cash till. can just put the description that you understand. It's not cast on stone. So there is a movement. Money is leaving the bank and also entering into the cash. So these are all current assets, but one is increasing, one is reducing. So the one that is increasing is the cash at hand, right? Which is also a current asset. How much is 100,000, right? So we move to the next, we have to do the next entry, the second entry, because if we don't do it, this will not, it's telling us that you've done one, you are yet to do the next one. That's why it's saying no balance. Always note that. So the next one is the ultimate bank, money left ultimate bank, 100,000 into the cash. So it's credit. So you put 100,000. Are you there? So because the default is debit, but we are taking it into credit, meaning that it's reducing it. The default of current assets is debit, meaning that anything that is coming to current assets account that will increase it is a debit. That is the default, is a debit balance. So whatever that will be leaving the current asset, money is leaving our bank. Bank default balance is a debit. But because money is leaving, we made the entry in on the credit side so that it will reduce the balance in the bank. Then the cash will now increase and will make debit, because whatever that is increasing the assets is a debit. Whatever that will reduce your assets is a credit. Just have that in mind. Good. So we are done with that. But before we proceed, let's go and look at our reports, because we stated that this is an automated financial statement, meaning that as we are making our entry, those reports should be generating. Right. So let's go to the financial statement. Good. We've not made sales, so it's still 0, 0, 0, nothing. So you can see our statement of financial position. Wow. Money, we introduced money, cash in the bank, cash at hand. In mind, it was 3 million that Amaka introduced into the business. Then she took money out of the bank and into the cash at hand. You can see. So this reduced by 2009. This is 100,000. Then the inventory, remember, we bought goods on credit. Inventory increased, right? And our current liability also, accounts payable, 1.2 million. So these total assets must be equals to total liability and equity. Then the cash flow statement, you can see the cash flow statement. It must balance. This is the accuracy check here. It must balance. So have it in mind that all this, you can see there is the inventory increase, meaning that money is going out by cash flow statement. The money that is supposed to, you understand, will have sold and you put it in the inventory. So having your goods in inventory is tying down your cash. That is, cash flow statement is giving you the position of your cash presently. What is increasing your cash? What is taking away your cash? Right. Then you have your account payable. You see, because we are not paying immediately, you understand, to the vendor, we have cash to, run the business with, right? So you now introduce 3 million, which is the owner's capital, which is here, right? So this is what will be happening as you input your transaction, right? So the major work, as I stated earlier, is for you to make your entry accurately here, right? So let's move ahead. So we'll just pick a few transactions again, and so that this video will not be long and you get it once and for all. So the says on the 12th of January, sold 10 units of perfume for 120. So I want us to pay attention. Sold 10 units. Mind you, purchased 200 units. Out of that 200, is selling 12, meaning that the selling price is 12,000 per unit, while we purchase at 6,000 per unit. So on the 12th of January 2024, right, we made sales of 10 units, right? 10 units perfume, right? So we are making sales 10 units of perfume for 120. That is cash, meaning that the person paid into the bank, right? So we'll just say ultimate bank 120,000, right? Then the next leg is sales, that's revenue, right? So you put, then you select your sales revenue, this sales revenue, which is income, right? And income is a credit balance, so you put 120,000, right? So now have it in mind. If we're going to be making sales, meaning that our inventory will reduce, right? And we also need to capture cost of sales. So if we just make this entry, sales 10 units, money was paid into the bank, your sales revenue, we made sales, income statement. Mind you, there is a cost of sale because they gave us, we bought something at 6,000, we are selling it at. So there is a cost of sale, and we had something in inventory, and our inventory has reduced. So we need to also capture those elements. That's why in accounting, your double entry should affect two or more accounts. It doesn't just stop at two accounts, it can affect two or more accounts. So we just use the same 12, let me just say copy down and copy down. So now for our inventory will be reducing, and our cost of goods sold will also capture cost of goods sold. So debit comes first, and debit is cost of goods sold. So we have cost of sales, right? Cost of sales, and the cost of sales, we sold 10 units. 10 units cost is 6,000. Mind you, the selling price is 12,000, but the cost of sales is we value it at cost, and inventory is also valued at cost. So you put your word 60,000. I think 10 times 6 is 60,000. So you put your 60,000. All right. So which is debit. So the next entry is inventory. So you reduce your inventory. It's a current asset, but we are reducing it. So it's going to the credit side. All right. So let's see the financial statement and see what how it does. So you see our cost of sales 60 because we made sales. Mind you, if we have put that sales revenue without cost of sales, we'll be overestimating our profits, total income. You understand? Our total profit might be still the 120, but there is a cost of sales, right? Then remember your inventory has reduced. Where's our inventory? You see, our inventory is, remember it was 1,200, but now there is a cost of 60,000 that has reduced, right? So this is what I want to do. And you know, our account is balanced 4,260, 4,260, and the cash flow is balanced. Here is where you check your accuracy, right? So this is it. This is what I want us to know. So let's move ahead. Let's pick another transaction. And it says on the 15th of January, paid 1,200 to ABC Limited via bank. 15th of January 2024, right? 2024. So it made what? It paid one, okay, meaning that the money that we are owing the vendor, the ABC vendor, we are making payment, right? So payments to ABC Limited, ABC Limited, right? So we're making payment to ABC Limited. So money is leaving our bank, and the account payable will clear it, right? So account payable is what we'll first select because it's debit. So account payable is debit. So the next account is money that is leaving the account. So ultimate bank. So 1,200,000. Good. So are you saying that? So that is it for that transaction. All right. So we move to the next one. It says on the 25th of January, paid 25,000 for electricity. So let's presume or let's assume that this 25,000 was paid from cash. It's an expense, right? So it was paid from cash. So on the 25th of January 2024, we paid electricity expense. Electricity expense, right? So we paid from, let's assume we paid from the money we have at hand, cash at hand, right? Yes, let's assume that. So money left, so it's credit. So let's just start with the credit first. Okay. So then the next leg of the entry is electricity expense. So there should be an electricity. Let's see if we have electricity. Okay, there is an electricity expense. So you go there and impute 25 is a debit. Expense is a debit balance. So you can see that is a debit. So you can just go. So that is it for electricity expense. So on the 30th of January, paid 50,000 to sales assistants on the 30th of January. On the 30th of January 2024, sales assistants. So it's more like the sales assistant salary. It's a salary. So paid how much? 50,000 to sales assistant. So let's assume that, okay, money left, we paid our sales assistant via bank, from bank, not cash. Let's say it's from the bank. So the salary is an expense. So we'll start with the salary expense. Salary, wages and salary. So we have wages and salary here. So we paid how much? 50,000. Then we would credit our bank on the same tax, sales assistant salary. So it's the ultimate bank. Ultimate bank will be credit because money is leaving that account, 50,000. Right. So that's the entry. Now we are moving to February of 2024, which is on the 5th of February. So 20 units for 240 to Zico stores on credit. So on the 5th of February slash 2024, sales to Zico stores on credit. So it made sales on credit. Sales to Zico stores. So this is sales on credits, right? So if you're making sales on credits, mind you, your account receivable will be impacted, your sales will be impacted, cost of goods sold will be impacted, and also your inventory will be impacted because remember the first sales we made was cash sales and all these accounts were impacted, right? Now we are making another sales on credit, right? The first was cash sales, but this is credit sales. So for credit sales, account receivable, because the person is not paying, so account receivable is impacted. Are you getting that? So capture it. How much? 240,000. So we are selling 20 units. And mind you, our selling price is 12,000, meaning that it's 240,000. 240,000. Right. So the next account that is impacted is the sales account. The sales account is also impacted. Sales revenue is an income account. So you go to the credit side, 240,000. I need to show you this again. So mind you, we've already done its balance, but mind you that inventory will reduce because you are taking 20 units out of inventory. And your cost of goods sold is also need to be impacted because if you're making sales of 240, what is the cost of that 20 units you've sold, right? So the cost of 20 units, if you look at it, 20, our cost price is 6,000, so 120, right? So you just still capture that. So our inventory, well, let's start with the cost of sales. Cost of sales, which is a debit, so it's 120,000. Then the same entry, inventory, right? Which is inventory will reduce 120,000 by 120,000, right? So that is it. Let's move up. So let's pick another transaction. On the 12th of February 2024, we received the money from Zico stores on the 12th. So payments received from Zico stores. So if payment was received, money is coming into our bank, right? Money is coming to our bank, then the account receivables will clear, right? So you debit your bank, ultimate bank, 240,000. Then you credit your account receivables to clear it because it's paying 100% of the money is owing. Maca Global Perfumes, 240,000, right? So that we go. So if you look at the financial statement, you see account receivable is 0. All right, you understand. You can be looking at it as you enter each transaction so that you can see the impact of the transaction on the report, right? So the next is what on the 20th, purchase shelves and furniture for office use. So on the 20th of February 2024, on the 20th of February 2024, purchase of shelves and furniture, right? So this is a fixed asset. This is a fixed asset and money is leaving, right? So furniture, do we have? Yes, there's a furniture and fittings is a fixed asset. So it's a non-current asset. We purchased it for how much? 150,000. 150,000. So then the next account is our bank account, ultimate. Select ultimate for the account name that will be impacted on. So because money is leaving, it goes to the credit side, it's reducing our accounts balance, right? So that is it for this transaction, purchase of shelves and furniture for office use, right? Let's stop here for 2024. You can give this a trial when you get the template, give it a trial when you get the template and see how it works, right? So let's move to 2025. On the 1st of May 2025, on the 1st of May 2025, what happened? Additional capital was introduced. Okay, additional owners capital, additional owners capital. Please just bear with me. I don't want this video to be very long. So the other transaction is something I believe you can do without any challenge. So let's just do the second year. Pick some transaction for the second year so that you can see the impact, right? So additional capital was introduced on the 1st of May 2025, which is 2 million, meaning that our bank has 2 million, and equity, which is owner's capital, will also increase. So ultimate bank, 2 million, 2 million. Then the next account that will be impacted is owner's capital, So Amaka in Global introduced additional 2 million. Owner's capital is a credit balance. So that is it for that. So the next transaction is on the 3rd of May. Bought 150 unit perfume from XYZ Limited on credit. So we made some purchases on the 3rd of May 2025. On the 3rd of May 2025, purchases 150 unit perfume, 150 units perfume from XYZ Limited. Mind you, it's on credit, right? So because it's on credit, account payable will be impacted. We didn't pay, right? We didn't pay. We bought 150 unit perfume from XYZ Limited on credit. Account payable will be impacted and our inventory will increase, right? So inventory is the debit first. Inventory, so we bought it at how much? 900,000, right? I believe it's still at that 6,000 per unit, yes, 900,000. All right. So the next leg of it is, so because we bought on credit, so accounts payable, we are owing. Amaka Global for perfume is owing. So 900,000. So that is it for the 3rd of May. So on the 5th of May, so 20 units to Royal Touch on credit. On the 5th of May 2025, sales of 20 units to Royal Touch, right? On credit, sales on credit. So if you're making sales on credit, account receivables will increase and your sales will also increase. That's one side. On the other hand, your inventory and your cost of sales will also be impacted, right? Inventory will reduce and the cost of sales will also be impacted, right? So first of all, we'll start with the first one, sales. So account receivables, because it's on credit, account receivables. So we sold 20 units to Royal Touch at 240,000. Right, so you also capture that as your sales revenue. You can select from the drop down. Let me just scroll up so that you can see that. So you have a drop down, you can just select that, and this is an income. So income is credit, so you put your 240,000, right? So that is it. You have your 240,000. And mind you, as I stated, we'll have to also take into cognizance that this particular transaction impacts on your inventory and cost of sales. So we'll copy down the same. So let's start with cost of sales, which is debits. We made sales. So the cost of sales for 20 units at 6,000 is 120. So we'll put 120. So, and our inventory will also reduce by that 120,000. So inventory. So it's going to be credit 120,000. Right, I believe that's it. So received 240,000. Let's assume we've not received. Let's just assume we've not made any of those receipts. I just want to pick one or two transactions from here. Paid 70,000 salary. Okay, let's say let's pick this one. I just want to pick few of the transaction. Let's pick the transaction of 12th of May. 12th of May 2025. And just say salary payment. So you have your salary account, salary paid, so we are not owing. So 70,000 debit. So the money left our bank to pay the salary account, salary payment. So you put your ultimate bank, which is on the bank account for this business, 70,000. All right. So this, okay, that's for that transaction. So I'll just look at another transaction. I just want us to pick, and so we can say sold. Let's pick 24th of May 2025. Sales of 25 units of perfume cash. So we made sales, so 25 unit cash. So you can just capture that, and there you go. So if you're making cash sales, definitely the first is our ultimate bank. Money is coming into our account, right? Money is coming into our account, yes. So how much did we make the sales? 300,000. So debit 300,000. Good, 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 good. So the next leg is the credit, and which is the sales account, sales revenue, this cash sales, and 300,000. Good. So the next, because it's going to affect inventory and cost of sales, so we'll still have to capture that element. So inventory. So 25 units of 6,000 is 150,000, right? 150. So inventory is going to reduce by 150. Please always know where the leg, whether it's a credit or debit. Then your cost of sales too need to be captured. Cost of sales, and it's raining. So in case you can hear the sound of the rain, it's raining. So 150,000. So this is okay. So this balances up. So I think we've captured a good number of transactions. So let's just pick this on the 28th. When we pick the 28th, then personal drawing, we can pick personal drawings too, and that's all. So on the 28th of May 2025, paid 20,000 utility bill, utility expense, right? So we can just look at utility. Is there any utility expense? Let's see. We have electricity expense. So we don't have anything utility. Let's go to our chart of account and see. So this is what I want to show us. So we don't have for the expense, electricity, communication and internet, depreciation. So we don't have utility, but utility can be light bill, water bill. Well, for illustration purpose, let's just create an utility expense. So I'll come here and just select, I'll input a new row. So I'll just say 5025 utility expense. So I need to create that account. Do you understand? It's an expense account. Sorry, because I didn't, I'll just say Control D. It's an expense account. So I need to create that account. Having created that, I'll go to my general ledger, capture its utility expense. Definitely I should see that here, right? Utility expense, right? How much is it? Utility expense debit is 20,000, right? So 20,000. So before we do the second entry, let's just move to the financial statement. Let me show you something in the financial statement. Now look at the financial statement. We don't have utility expense here. You see the 20,000 is not shown. So we don't have utility expense here. So I may just like put in something here. Let's see. You can see there's a formula here, C38, C37. So there I will input a row here. I will just select and input a row here, then copy this downwards. Are you seeing the utility is now down? Then I'll copy the formula downwards. You can see it is now down. So it's working perfectly. So let's go back to the general ledger and complete this entry. So on the 28th, utility, money left, let's say we paid from the cash at hand. So cash at hand, we paid for utility. So it reduced to 20,000, and that is it. So the next transaction is on the 31st. So it's raining in my background. I know you are hearing the sound of the rain. That's the last transaction, 31st of May 2025. So we drew 50,000 for personal drawing. So this is like a personal drawing. So we'll say personal drawings. So money you withdrew for your personal use, not for the business, for your personal use, right? So what will be impacted? Your drawings account, which is an equity but with a debit default balance. So how much is 50,000? So money we withdrew for personal from the bank. Let's say it's from the bank. So personal drawing. So ultimate money is leaving the bank. Ultimate bank. Let me just go up so that you can see. So because it's leaving its credit balance to the bank, it's reducing our bank balance, and that is it. So this is all the entries I just needed to show you. We've done the entry. There are some entries we didn't capture, so that this video will not be too long. So you can see the expectation is for us to prepare journal ledger. So this entry automatically has prepared our journal ledger, trial balance. We'll go and look at it. Income statement, balance sheet, cash flow. You can see the income statement, balance sheet, cash flow automatically generate itself as we are making this input. So when you go to your financial statement, you see for the period, because we put 2024, so because we have both 2024 and 2025, you go back to your settings and say, okay, generate as at 31st, so that you can have both 2024 and 25, right? 2024 and 2025. So then you go back to your financial statements and you see 2025 current, 2024. So you notice for 2024 we have a profit of 105. 2025 we have a profit of 180. So look at our financial statements. So you notice that this total assets in 2024 is 3,105,000. Here we have 6,135,000, and you can see it balances itself up. Then our cash flow statement, we start with the net income, which is 105,000, as you can see up in net income. And this, then you can see everything balances. If there is any amount here, it shows that there is something that is not balancing us. So everything balances. So our income statement, balance sheet, and cash flow statement has been generated automatically. This is what I want to show us in this tutorial, right? So when you go to your trial balance under your chart of accounts, you will also notice the column for previous year balance and current year. You can see it's balanced. It's balanced. So your balance should be 0 per time. When you compute all your trial balance with your debit and your credit, when you minus them, it should be 0, right? So 2024 trial balance and 2025 trial balance is already automatically generated. So this is what this template does for you. You can see for yourself. So you can use this transaction to text on this template. So have it in mind that this template is premium, and the link to get it will be in the description section, right? So this is how the automated financial statement works in Excel. So this brings me to the end of this walkthrough tutorial on how the automated financial statement works. If you've gotten value from this, please give this a thumbs up, like this video, hit the subscribe button, and hit the notification bell to get notified when I upload subsequent video on a different business, and also looking at different transactions and how it impacts on the three financial statements, because subsequent video will be coming on how different transactions impact on the three financial statement. We'll still be using this template to illustrate that. So if you've gotten value, please share with as many that you know that will benefit from the use of this template. Thank you for staying true, and I'll see you in the next tutorial. Bye for now.